Well, good morning, everybody. Welcome to our last monetary policy statement for the year. The Reserve Bank this morning has decided to leave the official cash rate unchanged at 2.5%. As we did foreshadow in our last forecasts in September, the global conditions have continued to deteriorate. There's been continuing difficulties in sovereign and bank debt in a growing number of European countries, and this has led to higher volatility in financial markets. We're also seeing something of a softening in international economic activity, included in the Asia-Pacific region. These global developments are having some impact on New Zealand, although to date this has been limited. In addition, the international market tightness means that funding costs for New Zealand banks will likely increase over the coming year. There remains a high degree of uncertainty around this global outlook, as shown in our scenario in the monetary policy statement, where we record the possibility of the risk that conditions continue to weaken further. Domestically, economic activity continues to expand, though at a modest pace. Although off their peaks now, export commodity prices still remain elevated. In addition, the depreciation of the New Zealand dollar is providing some support to the tradable sector in New Zealand. In addition, over time, we still expect to see earthquake repairs and reconstruction requirements in Canterbury, providing a significant boost to demand for an extended period. Annual headline inflation is estimated to have returned to the Reserve Bank's 1 to 3% target band this quarter, and we estimate that underlying inflation continues to sit close to around 2%. In addition, we note that wage and price setting procedures have remained constrained. Ladies and gentlemen, given the current unusual degree of uncertainty around global conditions and the moderate pace of domestic demand, we consider that it remains prudent for now for us to keep the OCR on hold at 2.5%. Thank you. That's the end of the formal statement. Happy to answer any questions and to assist John McDermott and Satish Ranchod, who's been acting head of forecasting.
How long do you expect this uncertainty to continue?
I think there's varying degrees of uncertainty, but some of it at least is likely to continue for some time and well into next year. It's mainly sourced out of Europe. You know, the complications around the European institutions and the various attempts they're trying to do to improve things there. We don't expect to see that resolving itself simply certainly during the rest of this year, and it could well lead to continuing volatility next year.
What would you like to see from a New Zealand point of view come out of the European summit then?
We'd like to see a clear track to resolving the European situation, but we are very aware that it requires action by quite a different number of institutions, and not all of them are capable of resolution by EU leaders. Some of it relates to European monetary systems, some of it relates to the European Central Bank, some of it relates to national bank regulators, and there's other players involved in all of that as well.
So is a final resolution of the euro crisis likely to be towards the end of next year rather than any time sooner than that?
Well, I don't think we're going to see a sudden trigger that says the European crisis is over. We're going to see a slow grind which will partly reflect much diminished prospects for growth in Europe next year. So I think, as I was saying, we feel there's a mixture of decisions need taken on policy, on the balance sheets of banks, on sovereigns, and we only look for a gradual improvement in potential growth and actual growth in the Eurozone. So we're not expecting to suddenly see things snap back. More of an issue really, though, for us is would we see increased contagion in a way that could either hurt funding prospects for Australasian banks or in a way that starts to feed into reduced export demand out of China and other emerging markets, because both of those things would have a bigger impact on New Zealand.
You took the step to outline an alternative scenario in the MPS. I mean, how likely is this to occur? And I mean, if things keep on tracking on as they are in Europe, like it doesn't really look like they are resolving things very quickly, is it quite likely that we will be heading towards that alternative scenario?
Well, we still think the alternative scenario is an unlikely one, but it's certainly a possible one. And indeed, it's possible to think of worse scenarios than that. The scenario we've got in the monetary policy statement still allows for markets to operate and prices to work satisfactorily, but it does reflect a significantly higher cost of funding for the New Zealand banking system, and related to that, lower export prices and reduced confidence into the business sector in New Zealand. You could think of worse scenarios than that. This is one where the European situation deteriorates, but there still are markets funding around the world.
So if things do happen or they keep on stagnating like they are effectively, what would you like to see from New Zealand domestic policy concerns in terms of sort of fiscal policy? I mean, surely that would have to be part of the solution in New Zealand, is ramping up perhaps government spending again in order to help cushion the fall from the international markets.
No, not necessarily. I mean, we won't talk about fiscal policy per se. We'll talk about monetary policy, but we think we've got scope and we're in a reasonable position from a monetary policy point of view. On the fiscal side, clearly the government will need to keep focusing on having very good Crown accounts and being funded confidently by the international markets. That will be top of their minds at the minute.
With the increasing cost of money to the banks, how long do you see it before that feeds through in terms of interest rate rises?
Well, I mean, the increasing cost of funds to the banks has been something that's been really on the cards for quite a while, and banks have been aware of that and been feeding it through for quite some time. So we're not expecting to see a sudden change in rates at the retail end particularly. The banks are a little bit more squeezed than they might have been in the past. They know they have to continue to raise domestic funds because that's assumed more important than it used to. They, of course, are encountering some uncertainty in future financial market conditions. They're well funded currently. Actually, they've got a lot of liquidity at the moment. But again, they'll be looking at those European markets and trying to make their own judgment about whether they're going to open up over the next year or not. And if not, then you would expect them to be placing more reliance on domestic funding, be looking more cautiously at credit expansion, and be looking to other sources for funding. Our scenarios, going back to that question, do assume that you can still get short-term funding as you can now. It's really medium-term funding, secured funding, that we're talking about as being an issue in those European markets.
You noted that with the problems with long-term funding, that you expect domestic deposits to maybe pick up some of that slack. How much slack is there in terms of domestic deposit growth that there could be, do you think?
Well, at the minute, I mean, there is no slack in the sense that the banks have plenty of funds, and there has been a real willingness from New Zealand households to put money in banks, and that the banks are recognising that as an important source of funding much more than they might have historically. Were international sources of funding to tighten, then you'd expect them to keep both trying to attract domestic money and being prepared to pay for it. And it has been growing, and we would expect that could probably will continue, but it will depend on other conditions. Well, domestic funds as a proportion of bank balance sheets have increased significantly. We expect that to continue, yeah.
Do you have any concern that the partial privatisation might siphon off some of that retail deposit base?
We note, well, we've looked at the numbers in broad terms, and it looks like the sorts of amounts we're talking about from those mixed ownership model sales likely to be a very small proportion of domestic deposits. In fact, only account for something like part of the increase in domestic deposits over the last year. So I suppose on the face of it you might say that could slow the growth in domestic deposits, but we wouldn't expect it to do much more than that. A little bit depends also on what government might do with the proceeds of that.
If the term markets do remain difficult to get into, would you consider increasing the upper limit for covered bonds from above 10%?
We keep looking at various contingencies, but no, at the minute we're not considering that.
Dr. Bollard, how do you compare present situation in Europe, particularly with 2008? I mean, are conditions as bad as they got then? And if the Eurozone starts to break up, are we looking at GFC 2?
Well, conditions in Europe are quite worrying, but I think it is quite a different sort of set of scenarios from what we saw with Bear Stearns then going through to Lehman's in 2008. And as you know, the focus has been much more on sovereign risk this time. That's got different characteristics around it. And in the European case, it's partly a situation where exchange rates can't adjust appropriately for some of those member countries. So I think there's some real institutional problems, and they're showing themselves in real economic problems, but they are different from what we saw in 2008. We think at this stage is likely to be less contagion through to just freeze up of markets, but we clearly don't know exactly how that will play out next year.
Just in your forecast, you've cut back business investment. What do you think's behind that? Well, what's happening there?
What we're seeing is businesses and households continue with a degree of caution that they've had for the last 12 months, but the global scene has deteriorated somewhat. People read the newspapers, they understand what that means, and there's just the degree of caution has increased. If you look at the forecast, what's more pronounced is what we've taken back in residential investment. So there we're actually seeing consents not grow to the extent that we'd previously thought, and that's actually more material.
It is clear, though, that just the European uncertainty is having an impact on business uncertainty and business caution. And while businesses have got to make their own decisions, we hope that it won't lead to a general pulling back of investment plans, because that's important for New Zealand's growth for next year.
You've scaled back the TWI track quite markedly since September. To what extent is there a risk of basically imported inflation coming through there if the dollar continues to head downwards?
Well, look, I think the good news in this forecast is actually we're saying we think now we've been through that GST and other related charge increase impact on the CPI in a successful way without having it feed through into core inflation and inflating expectations. We now think, as we've said, that in this quarter we've got CPI coming significantly back and that core is still near 2%. So that means we've got a little bit less worry than we might have had otherwise with a softer exchange rate track. Our revision is enough to make a bit of difference on our CPI forecasts, but it looks pretty well controlled to us. But can I just say one other thing, sorry, which is, as you're well aware, we have a projection, not a forecast for the trade-weighted index. It will be wrong.
Over the last 6 years, your annual inflation rate has been above 3% for 60% of the time. Do you have any concerns about what that does to expectations in a longer-term structural
Well,
sense?
we would if we were picking up a view from our surveys that we'd sort of lost the inflation anchor. That's not what we're getting. We're getting generally reasonably reassuring responses from surveys on inflation. So people are broadly saying, yes, we can see that for certain reasons, principally these increases in tax recently, but before that, related to the housing asset boom, there have been periods when the Reserve Bank has gone above its target zone, but they are focused on medium term getting it back in zone. And really the forecast for the future looks to be very comfortably back within zone. So it isn't the top of our minds as a worry at the moment. Go ahead.
Given that the global conditions are likely to still be unsettled in January, is it fair to assume that you'll still be adopting an attitude of prudence towards the OCR at your next announcement?
We're a central bank. Prudence is our middle name, so yes. But that doesn't mean that we won't look at it with potential, take on board new data. You can see in our forecasts this time we're saying we're holding, and that's our short-term view, but we'll keep revising the data. You may see that the 90-day track that we publish in there is consistent with some gentle rises sometime in the middle of next year. That's our picture at the moment. But of course we'll revise.
Is it reasonable to assume that we're going to be in the same position in a month's time?
You mean in
terms of not changing the OCR?
Well, that's not inconsistent with the picture that we see at the moment, but the whole reason why we keep doing forecasts is the world keeps changing and we'll update.
Dr. Bollard, under your alternative scenario, is it likely that interest rates would need to be cut?
Our scenario for worsened European conditions that probably delivers an interest rate that's reasonably flat for some time. But the main point of that scenario is to allow you to see some of the interrelationships of if things worsen. Broadly to us, it says, well, the New Zealand economy still looks reasonably robust, even though it would grow at a softer rate under those conditions. But we do know the European situation could deteriorate. If it were to go to market dysfunctionality, then all those sort of bets are off.
So dysfunctionality being freezing up?
Freezing up of not just medium-term but also short-term funding. Bernard.
Dr. Bollard, the monetary policy statement talks about upward pressure on retail interest rates because of funding costs, and that, quote, monetary policy will need to take account of such pressures. Does that mean if the banks pass on or are about to pass on those higher funding costs, the Reserve Bank would cut the official cash rate?
No.
Why shouldn't the banks use some of the fat they've built up over the last 18 months, about a 50 basis point increase in the net interest margin? Why don't they use that to absorb those higher funding costs?
Well, broadly speaking, that's driven by competition in the banking sector, and there is quite strong competition, as you'll know, between banks at the moment. They're competing strongly for domestic deposits, and because of such limited credit growth, actually they're competing for the opportunity to lend as well. We think that's a more useful competitive restraint on them than we can do from a regulatory point of view.
But that competition hasn't actually reduced margins. The margins have actually increased over the last 18 months.
Jason, do you want to comment to that at all? Jason Wong, head of our financial markets. Thanks.
I guess if you took a longer term perspective, margins were squeezed leading up to the GFC, and then they've sort of come and rebound a little bit. There's a bit of compositional effect going on as the mortgage book moves from fixed rate mortgages, which were lower margin, into higher margin floating rate mortgages. There's been some expansion of margins there as well. So I mean, margins have been sort of coming and going, and we don't see it that they're taking excessive profits in this sort of environment. In fact, when we look at some of the pressures, we see banking funding pressures. You can just see those long-term wholesale funding pressures really start to bite, and if that continues, obviously it's a cost they've got to face down the track.
Do we have any Christmas proverbs?
Well, thank you, Barry. Actually, you will recall what Cervantes said, that he who keeps a closed mouth catches no flies. Do we have any more questions? Well, if not, I should thank you very much for the year and the work that we've all done together. So we appreciate your custom and your communication and intelligence, and we hope you have a very good Christmas, but that is not a forecast. Thank you.
Well,
Alex.
on the case of Proverbs, we have also got together and bought you a book of Proverbs for a Merry Christmas present.
We're hoping for improvement.
Well, thank you. We are overwhelmed. But we do note the old Turkish proverb that says, "A rose and a thorn grow on the same bush." Thank you very much, everybody.